An unusual options trade is quietly taking over institutional desks right now, becoming the favored hedge against sudden policy shifts concerning Iran. This specific strategy is the TACO, and the sheer volume signals deep institutional concern over potential whipsaws in the global oil market. What we're seeing isn't just a tactical options play, it's a reflection of oil's enduring structural importance to the global economy. Crude oil isn't merely a commodity, it's the bedrock of industrial output, transportation, and chemical production worldwide. Any significant disruption directly impacts everything, from freight costs to manufacturing margins. The value proposition of crude oil extends far beyond simple energy. It's intrinsically linked to national energy security and geopolitical stability. This makes the Middle East's role critical, as a disproportionate share of global supply transits through choke points like the Strait of Hormuz. Any perceived threat in this region immediately creates a risk premium. Now, let's look at the actual supply-demand picture. Despite global growth concerns, demand remains surprisingly resilient, particularly from emerging markets. Meanwhile, supply has faced its own constraints, with OPEC Plus maintaining discipline and US shale growth moderating. This delicate balance means small shifts have outsized impacts. Global inventory levels are the next key signal. Historically, declining inventories provide strong price support, and we've seen drawdowns in key storage hubs. While strategic petroleum reserves have offered some cushion, their finite nature means market reliance on active production remains high. This fundamental tightness underpins the current risk premium. That leads us to the management of the global oil market, OPEC+. Their recent production cuts have clearly articulated a strategy focused on price stability, often at the expense of market share. This collective action provides a floor to prices, but also concentrates power, making geopolitical events even more impactful on supply decisions. Then we have the unpredictable capital allocation from the United States, specifically regarding Iran. Sanctions, waivers, and the potential for a sudden shift in diplomatic posture are the primary catalysts whipsawing markets. President Trump's past actions demonstrate how quickly policy can pivot, directly affecting Iran's oil export capacity and global supply. This brings us back to the TACO hedge. It's an acronym for Target Accrual Redemption Offshore, and it's a sophisticated options structure favored by institutions for managing tail risk in volatile markets. Essentially, it allows traders to profit from small, contained movements but provides outsized protection against extreme price spikes or plunges caused by geopolitical shocks. The crowding into this specific hedge tells us something important about institutional positioning. It suggests an expectation of continued volatility, with low probability but high impact events. This isn't about directional bets, it's about insulating portfolios from sudden, dramatic shifts that could decimate returns, irrespective of broader market sentiment. The primary risk here is, of course, geopolitical escalation in the Middle East. Any direct conflict or significant disruption to oil infrastructure in the Gulf region would immediately remove millions of barrels from the market. This isn't just about price, it's about securing supply, and the market appears to be pricing in a non-zero chance of such a catastrophic event. The systemic headwind from such a scenario is massive inflationary pressure. Surging oil prices feed directly into energy costs for businesses and consumers, eroding purchasing power and forcing central banks into a difficult position. This could trigger a slowdown in global growth, exacerbating recessionary fears, especially in import-dependent economies. Our forward earnings visibility for crude oil remains clouded by this geopolitical overhang. We're in a structural momentum play where underlying demand is strong, but the risk premium is the dominant variable. Expect crude prices to remain elevated, with sharp, unpredictable spikes tied to news flow. This isn't a market for the faint of heart, it requires deep asset insulation. For investors, this means a re-evaluation of energy sector exposure. Companies with strong balance sheets and diversified operations, like ExxonMobil or Chevron, could see relative strength. However, the broader market will experience yield pressure as inflation remains a threat. We see continued capital rotation into defensive sectors that can better absorb rising energy costs. Considering the dynamics, the broader energy sector, represented by ETFs like XLE, is on breakout watch. not necessarily for massive structural growth, but as a strategic hedge against geopolitical risk and persistent inflation. However, indiscriminate buying is a trim consideration. Specific companies with strong free cash flow and dividend yields will outperform. Navigating these complex structural shifts requires more than just headlines, it demands deep institutional analysis. For continuous insights into these critical market dynamics, make sure you're subscribed to SR Money News. Hit that like button, leave a comment, and stay ahead of the curve with our premium market intelligence.